Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Did you panic on this last downturn here and possibly go to more safe investments? Did you happen to do that? I saw a study that showed that 16 times more trading was done on the Friday of the low of this stock market, this last decline here, than any other time, right? People were moving from their equity funds, moving over to bond funds. They were saying, I want out of this nonsense. The market's fallen over 10%. I want to move more towards bond funds. Unfortunately, that's like the worst thing you can do, and I want to illustrate that for you today, and I'm going to show you in two different ways why that's a horrible thing for you to do. The reality is, in your 401ks, your IRAs, Roths, things like that, you really want to look at what are you shooting for, and did anything change with that, right? Are you retiring in 15 years, 20 years, whatever it may be, or 5 years it could be, and did something change there? Because the markets are going to do what they're going to do in the meantime. You want to make sure you're prepared for that ahead of time, so when the markets start falling, they get a little bit crazy, you don't get a little bit crazy, and you actually kind of, hang in there, right? So we actually only had one customer ask the question, should I go to something more safe? Not one single customer said that they wanted to move to something safer, because we dial you in for your specific goals in terms of whatever you're shooting for. So we're already in place. So we already know that. We manage our own funds here, so we can take the volatility out of our funds, and we spend a lot of time on doing that. So anyways, I want to illustrate this for you. Not a marketing pitch today. Let's take a look. Let's say you're an aggressive investor, and you have something that did really well in 2019. Everything's really, really strong, and it just was trending along doing really great, right? You go, all right, I'm happy with that. All of a sudden, like what just happened, stock markets fall 10%. Well, it was like 12 or 13% from the highs, and they do it in like 6 days, and you panic. Let's say at this point, you had this investment. We'll say this is the market in here, so you were doing well. You're basically tracking the market, maybe beating a little bit. The markets also fell, so all your investments went down, and at that point, you said, okay, I want to move to safety. I don't like this. Here's what happens. This is the trouble with this, is now the markets start to recover. At some point, they start to recover, but your new safe investments move a lot slower. So now you start recovering at a slower pace, right? Now you're stuck. What happens here is all of a sudden you start seeing the market take off, and you go, shoot, should I get more aggressive again? We already missed out on 5, 10, 15% to the upside. Now you're forced to say, well, when the markets fall, I'll tell you what, when they fall again, I'll go be more aggressive. That's really tough. That's one way to illustrate it to you. The other way I want to show on the screen here, this is our actual portfolios through the October, November, December decline in the stock market. What I did is I took our least volatile fund, our really slow, low volatility fund. You can go to our website and look at our portfolios. It's the one on the very, very bottom there. It's a slow mover. It's designed that way. That's the purple line that you see there. The orange line is our large cap fund. So this is going to be is much more volatile. It's going to obviously provide more growth and everything, but it's more volatile. So if you look through October at this high here through the end of 2018, we fell 20% in the stock market. And just for fun, I'm going to put the stock market over the top of it so you can see. That'll be your light blue line on the screen there. So the stock market falls 20%. Now in this case, it happened over 3 months. So you had time to go, am I doing everything right? Is this all working the way I'm supposed to? Okay, no, don't panic. All right, no problem. When it happens over 6 days, of course, I can understand a little concern there. But here's what happened. Stock market falls 20%. The lows are off on the y-axis over here on the right. We fall about 20% off the lows. We start recovering. Now imagine you have the large cap fund or something aggressive like this, and the markets are falling, and you say, oh no, I can't take it anymore. I'm going to go to conservative. So you shift to the low volatility fund, the purple line there. It looks safer. Well, it didn't fall as much. That's okay. I like that. I want to stop the bleeding. The problem is, as you look forward, the large cap fund and the stock market start to recover. They recover faster than the slower moving products. I use the analogy of driving a car. Stock market's going at 80 miles an hour. Do you want to go 80 miles an hour, 90 miles an hour, 50, 30, 20? What is it that you want to do? Because that car, whether it's going in reverse or forwards, is going to move at that speed. So if you move to something like our low volatility fund, sure, you got a little bit of a recovery there, it looks good, but all of a sudden you look back at that large cap fund or you look back at the stock market and you go, that sucks, man, I'm missing out on all this, right? Now you're forced to say, well, when it pulls back, maybe I'll get in. Do you know it didn't pull back, right? It actually just kept going and going and going through the entire year of 2019. but because you briefly panicked and you moved to something slower, you're not recovering as fast as you would have. And that is such a problem with people, especially when your 401ks, nobody's helping you there. That's not fair. So they're not helping you. You don't know what to expect or whether you're supposed to panic or not. So you make these decisions based on emotions. You want to make the decisions based on your goal. Know your number and know the investments. As soon as you know that, you are set. You go, okay, I know I can handle 3 10% downturns before I retire. I can handle 120% downturn and have the markets not recover for 2 years. And if that happens, I still have enough money to retire. You got to know these numbers. I just did a video on that to kind of explain why knowing your number is so important. But anyways, just wanted to highlight that real quick. Didn't mean to take a lot of your time, but you want to check that out. Do not panic on these downturns. That was only 10% what just happened. Remember, in October, November, December of 18, markets fell 20%. What happens if the markets now fall another 10%? If you're already starting to panic, are you really going to panic there? Don't do it, right? Talk with someone, get some help. And if you want some help, of course, that's what we're here for at Jazz Wealth. We manage our own portfolios. We help our customers through everything. We do the investing for you. So we flip a switch. You can't panic. You have to call me, or you've got to go through us to panic, and we'll help you through it. But anyways, I hope you'll check us out. Thank you so much for watching. Enjoy the rest of your day, and we will talk to you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.